Always buy the dip, you idiot. Always buy the dip, you idiot. It looks like Federal Reserve is not trying to pop the balloon anytime soon, as the inflation is going up after the 7% rating that we have discovered yesterday. We can find that even quantitative tightening, if it will finally happen, won't stop the inflation right after. So what are the possible shelters for investors, and where we can really hide our money in order to run away from inflation? That's one of the topics of today. And also I'll be talking about the upcoming days regarding what economic calendar will bring to us, and right after this we'll be talking about also quite important topic that may boost a surge in popularity among crypto. At the end, as always, I've been putting trade ideas, so let's stay by the end. Okay, so we are jumping up to market mover section and heading towards something that may interest lots of you, because many of you have probably wondered who is buying the index dips. We can find that institutional clients right now throughout recent weeks has been selling off the stocks. However, corporate were net buyers right over there. Who would you rather trust, the corporate or institutional clients? Because I definitely pick the first. And right now we are heading to yesterday's gauges of inflation that the whole world is debating about. 7%. It's the highest level since 1982. And this gauge measures the cost across dozens of items. I would say it's more like the theoretical rating, because as we can find, even the US oil has surged throughout 50% since last year, and so I would say that practically it's over 10, even 15%. However, the CPI is quite scammy gauge that is, or rather that which one base is changed throughout some organizations among the time. So something that may bother us is that inflation is going to be with us no matter whether they increase rates, and the challenges of the economy here just going to build on that. So even not Omicron or other virus and other variant of COVID will bother us to that extent as inflation is around the world. So even if interest rates will be finally risen, as the Fed considered to make a shrinking process for some trillions of bucks, we still don't have a certainty how this balance sheet shrinkage will impact the economy of financial markets. Right now we have still suffering with bottlenecks, and it looks like it may even get stronger. So this trimming may be quite tricky if we need to balance the economy condition and also our gauges of inflation. So it quite of a very difficult problems to be faced by Fed on the upcoming months. That's recently Shanghai and Xiamen port calls increase as ships reroute from Ningbo. We can find that there are some bottlenecks that really getting more troublesome, and we can find that this gauges, unfortunately for us, is getting worse every single consecutive month. So eventually we have a situation where the port congestion issue will continue to impact restocking cycles in first quarter and maybe the second one, and it's alongside the virus outbreak. So right now there is a very tough question among politics whether we should put the economy and condition of it above personal wallets. Fed's Brainard said controlling inflation is most important task, and gives our savings the high priority. I would say so that it's very important to have such politics that should take care of our savings, not only the debtors. Definitely, it's a very good stand from Mrs. Brainard, and I would say maybe the prices and the inflation problem will improve, but it will be more like the amplification by the softening of goods demand rather than lowering the problems that are so difficult to be tackled. So Fed's Brainard has a very hard nut to crack. Right now also the whole Fed is really scratching their heads whether to find a solution in this case. In the past we've seen that wage growth had tend to follow Fed funds rate. In this time it's quite different situation. As we can find, wage growth has took off, however Fed funds rate has remained stable. Will it took off to face the growth of wage growth? It will be very difficult, as nearly no one sees such a high Fed funds rate in the coming months. The 2% level is possibly one of the highest one that may be seen within 2 next years. And beyond this, despite higher wages, inflation gave the average worker a 2.4% pay cut last year. So it's really outstanding how the things are going and how desperate may workers be. So right now, as Fed is really trying to introduce the quantitative tightening, right now they are still buying 60 billion of securities just this month, and another 30 billion next one. So why they won't just trim it down right now? And they are just saying, but it doesn't really shift on what they are doing. On the other hand, there is still a light in a tunnel where Capex outlook is looking quite optimistic. right now this chart is showing us that there is a still prospect of a possible multi-pronged investment boom. The chart right here is right now showing us a typical cycle leads and lags in terms of capex growth, and with easier funding conditions, if it will be maintained, and also booming with easier booming corporate earnings and rebounding economy, we could find that S&P 500 corporate capex should follow this one up to 2023. So right now it's a little bit too early to say whether we will find a quite a robust period on this corporate side. However, there are some also gauges that showing that we are not over yet. Okay, and right now let's talk about crypto outlook. And for today's schedule, I have some CBDC talk. Digital currency race prompts trials, scrutiny by Bank of Israel. So among some of the countries that, as we can find, are interested in CBDC, central bank digital currency technology, there is some of them that already issued such a technological asset. However, some of them actively exploring CBDC feasibility and conducting early research and or experiments. Among them is Israel, that right now is expecting to introduce such a token into an economy. A token like the digital shekel could reduce the risk to financial stability and monetary sovereignty if the public adopts private coins or digital currencies issued by other central banks, according to a May report by the Bank of Israel. And that is getting more and more interesting regarding such threats to some of the countries as Russia, that after invading on Ukraine has been put in a possibility of being cut off from SWIFT. So it may really sting the economy of Russia, that has tried to defend itself and join with Bank of China to its version of SWIFT. However, if we'll have such of a digital currencies that will be put on a public blockchain, that is also of some probability, we won't have such barriers, and this network will be unstoppable. So it's quite of an interesting topic to be discussed, and CBDCs might be also the topic that may boost crypto's interest upon a time. So there is for cryptos this year another light in the tunnel, so it will be very interesting to follow. And right now we are jumping up to trade idea section, and as a quite of an interesting speculatory bet, I would have a rather quite risky proposition for you. If you are quite tolerant to risk, you would consider this as a quite good opportunity. Short sellers tuck into Beyond Meat, and recently, thanks to Financial Times, I have found that Beyond Meat, that I have broadcasted a video about the company in September or at the end of August, is right now, as of January of 10th, the most shorted stock in Russell 1000. So it means that considering how the things were going in 2021 and 2020, when the company has been highly shorted, or rather found the highest interest as a percentage in a short among investors. It usually became a target of such of a group as, for instance, WallStreetBets, that is trying to just take advantage of a possible squeeze to the upside that will be cutting off and liquidate those short positions. So looking at Beyond Meat, I would expect, as the US indexes are rebounding, I would expect January to be a quite good month for this company. So in terms of price performance, obviously. So Beyond Meat is right now working up to fill the gap, but it's quite far away from there. But taking into consideration of potential squeeze that may happen, we still have around 34% of gains. So that's quite optimistic scenario. I would say that with a quite tight stop loss right around, I would put it below this spinning top candle right here. There is still risk-reward ratio at the level of 3.3, and I do expect with this slow march of a move that we may see a potential speed up in price to the north. So Beyond Meat is on my target. Whether we will cross and close the candle above this 70.2 area. So I would enter a position on a buy if we just cross 70.6 area and will close our candle above it. So right now it has potential to get out of this tight range, and if it will happen, there is a quite clear path to another highs of 74, and right after this 84, and finally filling the gap at 93. It's still a long way ahead, but looking at recent very low performance, there is still quite of a probable that we will make such a move. So Beyond Meat is quite interesting stock right now, especially after this short interest. But remember about risk management, and obviously don't risk more than you afford to lose. And that's it in today's video. Thank you very much for watching. If you have any question, just put it in the comment section below the video. And if you enjoy my content, click the subscribe button. Thank you very much, and see you tomorrow.